we've only done this once before, and we are a distributed business. We don't have an office anywhere. So we literally did it on Zoom because that's where we live. But we thought it exciting to do this in person. So let's give it a try. All right, Africa Eats. We are here to make a dent into hunger and poverty on the continent of Africa by investing, right? Not by grants, not by charity, none of that. That's nice, doesn't make a big difference. What makes a big difference is investing in companies building the food and ag supply chain. You can literally give incomes to farmers, and you can literally get more food to market and get rid of some imports. We invest in companies. We'll hear this term a lot today, and if you're here for multiple days, the rest of the time we call them BZ. So Africa Eats isn't Jumane and Lily and I. Africa Eats is us and all those companies. We don't own them outright. We're just minority shareholders, but we think of Africa Eats as the whole thing. And we build that culture that we're doing this together. So we didn't want to call them investees. We didn't want to call them portfolio companies. We didn't want to call them anything that sounds like they're other. We needed a word that sounded like they're part of us. So at the very first gathering, I sent out the ask to the room, what should we call you guys? And we came up with, one of the entrepreneurs came up with Mbizi, M-B-I-Z-I. Anybody know that word? Is that a word in anyone's home language? No, I don't think so. It's Shona for, it's elephant, right? I think it was elephant. And then about a month later, somebody from Uganda said, why are you calling your companies pigs? So we dropped the M. So there's just the BZ from now on. All right, as we had said in the quiz, we celebrated on December 3rd, not just the listing of Africa Eats, but we also listed two other companies. We listed Zoeto, Biden's over here in the audience, and we listed Elite Meat Processing, which operates under the name of Paniel Meat Processing. And I saw Hervé in the room somewhere. There's Hervé. And so there are three companies now publicly listed on the stock exchange of Mauritius. We have our investment advisor in the room as well. We have our chair in the room from Mauritius as well, who all helped to make this possible. That was the huge milestone. This is what it looks like. Not only did we list the three companies, but we worked with the stock exchange to create a whole new segment specifically for fast-growing, profitable companies. Our goal is to bring all of our success stories to the public markets. That's where the money is. We need growth capital. The growth capital can be found on the public markets. So that is why we're doing this project. And these are the first three, but not the last three. This is a little screenshot from the Stock Exchange of Mauritius on Monday. Now, I talked about this in words before, but 2024 was another good year. Good year to us is that revenues go up. So this is what $600,000 looks like in 2014, right? In the same graph, in the same scale, that's what $44 million looks like in 2024. Of course, the growth was not evenly distributed across all the companies. One of them got really, really big. Another one didn't even get started until 2020, but it's our second biggest now, and so forth. So this is $16 million and 8, and about 6 and 5. That's $1 million. Like that one up there where I'm pointing to. That little tiny sliver is $1 million a year company. That's a nice milestone. We like that milestone. So back when we started Africa Eats in 2020, we had one company that was over $1 million, just the blue one at the bottom. Now we have 10. So we're proving that it's possible to take these companies that otherwise most investors think are uninvestable, invest in them, help them grow, handhold them through the process, get them to be $1 million a year companies, and then 3, and then 5, and then 8, and then 16. That's totally feasible. We know it's feasible because we're doing it. Right? We're doing it in 9 different countries on this continent. We can do it across multiple sectors. So for the first time, we broke this down by sector. We never really looked at that before. So we have the main group. I talk about these aggregators who buy from smallholder farmers. They aggregate fruits and vegetables, grains. They press cooking oil. That's the top group. That's the biggest one. Second is honey. We have 5 companies that work with beekeepers, work with smallholder farmers to make honey and beeswax. It's not our second biggest group, but it's in the same style of business. Third is that company didn't start until 2020. Hervé started this cold logistics company because there wasn't one in Rwanda, so he made one. It's now the largest of its kind. It's our entire logistics sector on this chart. It's just one company. Then we have some companies doing meat and dairy. We have a few companies, one company that sells seeds to farmers, and one that sells animal feed. Oh, sorry, animal feed's in the next one. And then some two companies that do agro-vet supplies, veterinarian supplies. One that makes animal feed, actually one and a half that make animal feed, and then a few other at the bottom. The commonality here is they're all in food and ag. We can also split this up by country. So we've seen, first time we made a chart of this and published a chart of this. We know this internally, but have never really shown it. What I take from this chart is if you go back and look at 2015, 2016, 2017, yeah, green's a little bit bigger because that's our first company that was already $1 million in 2017. But take that out, they're all about the same. So we had a series of very small SMEs, right, still in the S part of SME, back in 2015, 2014, 15, 16, 17, even 18, you can see they're starting to grow. 2020 is when Africa Eats spun out of my accelerator and had some money for these companies, and that's why the curve changes. But it was pretty evenly distributed across the countries back in the 2010s, and all of a sudden, bam, Tanzania takes off. Why? These things just happen. There's no plan. This is just some success shows up for some entrepreneurs more than others, and we just happen to have a whole lot of luck in Tanzania, right? And Rwanda because of this logistics company, Uganda because we have a company that does a great job selling seeds, and Kenya not as much. So what we see as managers of this investment company looking forward is we need to balance this out, that we're a little bit over-committed to Tanzania. And so we need to find more companies in more countries to try and balance this out to make it more even. Our target market is sub-Saharan Africa. So that's 45 countries. We need a lot more countries on this list.
So just now what Looney just last illuminated was we have a concentration in Tanzania. Now, when it comes to ESG, for us, it's a subset of risk management. So saying that we have, we don't control where the growth takes place, but we just have to be aware that if there are imbalances. What I mean by imbalances is, for us, ESG is not a nice to have. It's not a tick box. It actually has to do with how do we manage risk overall. So if there's a concentration, so for example, if I pick Tanzania, some of our entrepreneurs here are aware that we had droughts that took place in Tanzania recently over the last few years. We've had locusts, for example. So how does that affect our entire portfolio? So for us, ESG is a way for us to identify the potential risks that we see, especially in the sector that we're in. As our companies grow, they become the largest within their sector. They become the largest within their country, which now means that the entire value chain within that country now becomes something they need to be aware of because it affects their business. As they move from one country to another, the same thing happens as these become the largest brands across their country, across the region, and eventually across the continent. And so because of that, we've been systematizing the process of identifying risks, whether it's the environment, whether it's social, whether it's the value chain, whether it's the community, all those various levels. And so the system we've put in place is IFC's environmental social management system. I'll be honest, so when we started this process, we've made significant gains, but as we're learning as we're engaging with our companies, it's not sufficient. So the IFC's put a standard, and it's great to have a standard, but what we're learning is because we're in the business of agriculture and food, then obviously we're very much in touch with the environment. And so what we're doing is we're slowly customizing this per company, advancing this, so that we can then ensure that we identify risks ahead of time as we grow our businesses.
All right, so it's an earnings call. Let's talk about earnings. We're an investment company. Of the financial statements, the most important to us is the balance sheet. For anyone analyzing this company, first place you should look is the balance sheet. So let's look at the balance sheet. How much assets do we have? Right. So as an investment company, we own minority stakes in 23 companies. And how much is that worth? That's the hard part. So of 23 companies, 21 are privately held, majority owned by their founders, minority owned by us, occasionally with a co-investor. How much are they worth? Well, there is no one way to figure that out. There is nothing. They teach you like 6 ways in business school, but none of them are the sole standard for valuing small private companies. So we have a process internally, and then we have our investment advisors in Mauritius. They do evaluation as well. We both did the work. We came in within 2% of each other. The auditors, this is straight from the audited financials, the auditors went with their number because they're external. And so it came out to $26,988,496 of value in that equity portfolio. We also have some loans. So we're not only an equity investor, we're primarily an equity investor, but we also do loans to these companies. So the loans have value as well. It goes up and down each year. That's another $1.2 million of value. And then we have cash in the bank. We have a few liabilities. Over the years, we've had many, many asks from our companies in terms of they need more capital to go do something. We don't always have the capital. We've been cash starved since the beginning of this business. So over the years, we reach out to our investors and ask them when we're private, can anyone please provide some capital to buy another truck or buy another piece of equipment or cover an invoice financing? And usually the answer is yes, not always, but usually. And sometimes if it is something like an invoice finance, the investor will say, can I lend you the money? Lend Africa eats the money, and then you guys lend it on to the company. Therefore, the investors we're backed up by this balance sheet, and they don't have to deal with the individual single investments into companies, loans to companies. So we take on that debt. We're sitting at about $500,000, just over $500,000, and it's getting repaid over time. It's debt. All right, looking back. So that was 2024. We got incorporated in 2020. And so this year, and probably this year only, we're showing all the balance sheets back to 2021. First time we did an audit was 2021. And so you can see on this line here, don't have it called out. We had $3 million of assets when the company got started. It's a spin-off of an accelerator. We had 5.7. We almost doubled that by the end of 21, grew to 8.6, 16. And now 26 or almost 27 million in equities. And then the totals at the bottom are slightly higher again because of this. It's slightly higher because of the debt as well. And you can see the debt jumps up and down. Okay, we do of course have an income statement because we are an operational business, but we're an investment company. And so the key line is the one at the top. And the one at the top says that, look, we had $8 million of revenues last year, or income last year. And just to be clear, we're an investment company. Those are the gains of our investments. That is not cash that came in the door. So again, we believe, and the way these companies are typically valued is you look at the balance sheet. The income statement is accounting fiction. I'll say that's for real. This is IFRS standards on how you account for unrealized gains. They go in the top, and that's why that's there. And then we have expenses because we are a business, and those expenses last year jumped up a lot from the year before. And the reason they jumped up is that it costs a lot of money to list companies on the public market. So we took on that as a project on purpose, knowingly spending that money because it wasn't a one-time expense to us. It was an investment in opening up the capital markets to not only those 3 companies, but all the ones that come later. So as an investment company, one thing we do that's very different than a fund is that we'll spend money off our income statement that will make all the companies stronger. We'll build infrastructure that will help not only these companies, but the next ones that join into the system. And this was a great investment, we believe, but a very expensive one. So that's why our expenses went up. And then there's this thing over here that hopefully next year we can stop calling out, which was a mistake by a previous auditor. that got fixed. So that auditor got fired. The auditor that did the 2023 ones, they got replaced by an even better auditor now that we're public. So hopefully the mistakes are in the past, or all the huge mistakes are in the past. That's not a real loss. And then lastly, of course, we have a cash flow statement. But again, it all gets driven off the top. Numbers are negative on here because that's the way it works on a cash flow statement. And so again, this is really just the unrealized gains of those investments at the top, and that 900,000 non-loss is in there again. And then the one line in here that's really important is how much money did we put out there? So we're an investment company. We only make money by investing. And total last year, we put out $1.8 million of investment. One thing I'll point out, everything I've shown you, that $44 million of revenue, all these companies and whatnot, we've only ever had $14 million in this company. We built all that on $14 million. And last year, we only got to invest 1.8 million of it. That's all we had. And the rest of it, well, we paid back some of those loans. So that gets taken out of it. All right, so I talked about how do you do evaluation. There is I think this one came out to 48 pages. I think this valuation report, the first one they did before we went public was like 62 pages. It's complicated. As I said, there's no standard. So this report lays out the details on how this all works. I'm not going to walk you through it. I'm going straight to the last slide. In the last slide, this is where that number comes from. So they looked at nearly all of our companies. If some of them we just counted as zeros because they're tiny investments, just saving us all time. Wasn't going to move the first 3 digits. So we looked at the biggest companies. For the ones that are public, those were easy. Those are their market caps. For the next few, we looked at some discounted cash flow models. We looked at some multiples on earnings. We looked at some term sheets that had come in. And so it varies from company to company. But the way this gets valued is looking at each individual investment that Africa Eats has made, and what is it worth today. So how much is that company worth? What percentage do we own? And then sum that up. And so the sum in this particular valuation report was 26 and change. So where's that go? Right, besides the balance sheet, where does it go into? Well, it goes into the share price. So we are, again, a publicly listed company. We have a share price. It's $2.53. At least it was this morning. It might be higher or lower at this point. Stock market's open. And so where do we get the 253 from? Where do the buyers and sellers on the market get 253 from? So this is literally a screenshot from our annual report, which I don't know where we put those. We have a few copies lying around. It's about to be published on the internet. And so it's really simple. You take the total assets of the company, you subtract the total liabilities, and you get basically the same line on the balance sheet, this total equity. Right, so that's $27,499,000. Then you divide by the number of shares outstanding, and as of December 31st, it was 10.8 million shares. And that math says that the value of the company per share is $2.54. We're currently trading at 253. Pretty close. One other thing we did with this was to look at what that growth rate is. So now we've been around for almost 5 years. It'll be 5 years July. So this is 4 years of growth on the chart here. We started at $1 a share because it was a nice round number. At the end of 2024, it was $2.25. So that's where that graph is showing. And if you just simply ask Excel to give you the closest match to that as an exponential curve, it's a compounded growth rate of 22.5%. That's the simple math. The closest curve to get you from $1 at the beginning to 225 4 years later, or 4.5 years later, is 22.5%. Okay, so keep that in mind. This is how it got broken down per year. So again, we started at $1 a share. We didn't change the price in 2021. As a private company, you set your own price. So we just declared in 2022. We did the same math. It came out to like $1.30 something, but we sold shares at $1.25 to try and get people to invest, give them a discount. The next year we did the math, and I think it was $1.70 something, and we sold shares at $1.65. And the next year we did the math and it was 2 something and we did 225. And so that's where the numbers come from. This is a chart. It's again an homage to Berkshire Hathaway. So in their annual report, they've compared themselves to the S&P 500 every year since 1967, I think it is, in exactly the same format, because by now you figured that out. I'm just going to copy what Warren does if it works. And so we're comparing ourselves not to the S&P 500 because that's the biggest American companies, but S&P has another index called the All Africa Index. So these are the largest companies listed in Africa. Well, how did they do? Like, I didn't know until I made this chart because I hadn't been looking. So 2021 was a good year. That was the last good year. So the compounded growth rate, if you had invested in that index, was 4.47% for that same time period. That's right here. And that total gain you would have had over that time period was 19%. And for us, again, it was 22.5% is the computed number. And that's a 2.25x growth. It's 125%. But the way that works in this particular space in finance is 100% is you've doubled your money. So 125 is you've doubled and more. So we've been able to provide to our investors who came in at the beginning now it's 253, right? 2.5x return in less than 5 years. 2.5x return is what a venture capital fund or a PE fund promises in 10 years. We're beating them. Okay. So in that piece, let's go look at McKinsey, because McKinsey just published this like weeks ago. They did the benchmarking for private capital and public capital globally, which I had never seen. It's hard to get these numbers. So here we got 1 year, 3 year, 5 year, 10 year, and 25 year. I don't know why the quarters are like that, but we'll just take it as years. And the first line is the buyout section of private equity versus the growth venture capital part of private equity. And you can see the returns are pretty good 10 years. They were not very good in the last year or 3. And this is against the S&P 500 there at the bottom, had a great year last year, right? But the general gist that we talk about as Americans is that you should get 9 or 10% in the market. You can see 25 years, 8.2. Right, 10 years is doing a little bit better. But here we have the MSCI World Index as well, which is pretty close. Like it's a little bit lower, but it's pretty close. And here's Africa Eats. So again, I showed you these numbers already, but not in this form. It's 22.5% over 5 years. I'm just extending the time period to 5 years. We're not quite there yet. But the last 2 years were actually better than that. And we've beaten every single index on here. And we're doing this, investing in companies that buy potatoes from smallholder farmers, buy bananas from smallholder farmers, who buy chickens from smallholder farmers, who sell veterinary medicines to smallholder farmers. There's no tech in here. Like I said, Berkshire Hathaway is almost as big as these tech companies. Africa Eats is beating the California venture capitalists, and we're doing it with potatoes and onions and bananas and chickens and fish. This is quite an investable sector. Okay, so those are all backward looking. We're a public company, so I'm going to say some of these statements are forward looking because I have to say that. And we're going to talk about 3 little topics here. So quick update on the 3 listed companies. I showed you this price. Africa Eats is at $253 today. Elite Meat Processing is up 10 cents from when they listed to $1.95. We're waiting for their financials to get published to see what they're worth. We don't know, but the market wanted enough of this company that the price went up. And Zoeto did publish their numbers. I haven't seen them because I was traveling, and I know the valuation report was up. And then we're waiting on both of those annual reports, which aren't due till June. So we expect the market will follow what's been published, as opposed to rumor. There isn't a lot of rumors in these companies yet. But nonetheless, the share price went up anyway. And this is really just the fact that there are buyers out there who want to buy some of these shares, and they're available every day. And some buy, and they'll buy a little higher than it was yesterday. Okay, that's topic 1. Topic 2 is truck. So I mentioned this one. It got started in 2020 during a lockdown. It was a solution to how do we move meat around Rwanda, because Paniel Meat Processing, that's the logo here, was trying to move meat around Rwanda across the border into DRC, and there wasn't a vendor that Hervé could hire who had multiple trucks. So he started a company that did that. And here we are. It's not even, it's barely 4 years later, like 4 years and a month, 4 years and a day. And they did $8 million last year. 22 trucks. I think it's on the next slide. 22 trucks, 12 cold rooms, 14,000 farmers affected, 3,000 clients. If I go back here, it's not about Rwanda. It's about feeding Central Africa. The trucks go out to Mombasa and Dar. You see those red lines? Those aren't just the highways. Those are where the trucks go. And it doesn't fit on the map. The trucks go down to Lusaka and Harare. The trucks go all the way down to Maputo because somebody wants to import food or export food through Maputo instead of Dar. Why? Don't know. Don't care. They pay us. It's profitable. It's the most profitable business we have. And where's it going? We don't know yet. We're working on that. So we're working on that because this will be the next listed company. So we're working on them with the investment advisors to get them prepped to be a listed company because we need a lot more money. There's a lot more opportunity to move a lot more food around Central Africa. But everything before 2024 is real. It was bootstrapped. There was no investment in this company at all outside of Hervé in his pocket in 2021. He grew the company to $500,000 on nothing. And then he came to us in 2022 at the beginning and said, I have 5 trucks. Somehow he got to 5 trucks. Can I buy some more? Will you provide money for some more? It's the first time I've ever said, no, the money you're asking for is not enough. I have to give you more. So he accepted more. It was $200,000. That's all we had. I wish we had $1 million. It would have been a bigger company. We haven't even invested $1 million. We're the only equity investor in this company. Do you have any other debt? You got a loan like 2-3 months ago? Yeah. Okay. Beginning of the year, end of last year, they finally got a loan. But it made almost basically to the end of 2024 with just our money, less than $1 million. And here's the plan. Plan is to get bigger. Just sums up to get bigger. Here's big round numbers on where that money would get spent. Not surprisingly, it's more trucks, more cold rooms, sugar, because the trucks often come back from the ports empty. So let's fill them with something. Sugar's a nice, easy thing to leave in a warehouse in Dar. Doesn't go bad. And in fact, we got we did an early pre-public investment to buy some sugar. If you want to contact Hervé, he's right there. But if you're watching online, here's his contact information. And if you would like to invest before he goes public, please join us. Right? Okay, and the last one is very forward-looking, not yet approved by all the authorities in Kenya. Make that one clear. So I said a few times that these 3 companies in Mauritius are liquid. African stock exchanges are not known for being liquid. They're actually notorious for being highly illiquid. So our stocks are liquid because we started a sister company called Tuesday Markets, and its job is to make those stocks liquid. Its job, its actual purpose in life, it's a separate for-profit company, and its purpose is to make the African markets liquid. That's why it got set up. First thing it did was make our companies liquid, but that's not where it's going to stop. I already did that one. So we have a hypothesis as Tuesday Markets that if we can make these markets liquid and easy to invest in, that more people will invest in these markets, which will bring more money, which can then be brought to these SMEs, which then can be bigger and get more SMEs to show up on more markets and make them more bigger and so forth. Like, we think this is a virtuous cycle that started on December 3rd that will take a decade until it's making significant progress. We're not expecting an overnight success here. What we do know is that in New York, right, the biggest market there is, I believe the 2 New York stock exchanges, the value of those exchanges is larger than all of the European exchanges and the UK exchange and all the African exchanges combined. and all of the Asian, separately, they're bigger than all the Asian exchanges combined as well. It's a huge market. One trend we see there is that half of all the equity investments in those markets are invested through mutual funds, and what's the new version of that is exchange traded funds, ETFs. Half. We're talking trillions of dollars. There are, in fact, and there's all sorts of ETFs that can exist. You can make an ETF for the 10 largest companies. You can make an ETF for the benchmarks I showed you. You can make an ETF for the best of Mauritius companies and the best of East Africa companies and the best of Africa and so forth. These are all possibilities. What we're looking at as Tuesday markets is we want to make markets. We want to make these shares liquid, the best of companies. And if we make them the best of, and we've done the legwork to figure out which are the best ones, well, let's make an ETF, because that makes it then easy for investors to say, oh, I just read about Kenya. It's up and it's doing well this year. Why don't I just buy Kenya instead of trying to pick out Safaricom and what else comes after Safaricom? Like, I'll bet you if I poll the room of the Kenyans, people will have a hard time picking the fifth one. You might get three. Yeah. Anyway, so the question to the room, the question I'm going to ask, you can ask us in the Q&A part, but the question to the industry here in the market is, if we provided daily liquidity for more African companies, how many more investors would join in? If we provided this daily liquidity in the form of ETFs, how many would join in, and which ones? Which ETFs would be of most interest to the investors? So we're doing that legwork now, or Tuesday Markets is doing that legwork now to figure it out. Should we disclose? I don't have a slide for it. You should do that.
Sure.
Okay.
And so I guess in closing, apart from sharing our book, we did say that, in the room we have about 80 people in the room. And so this is, one of our first earnings calls, well, our first earnings call as a public company. But our plan is that we're going to continue doing this every quarter. And eventually, as Looney said, we're going to have about 40,000 people in the room. And so our hope is that it would look something like this over time.
So this is literally from my phone last year in Omaha, Nebraska. And you can't see everyone because there's like 5,000 people behind me in the stands. And that right there is Warren Buffett. I did move closer to try and actually see what he looked like. I moved over. They opened up these seats like a half hour later. So I did get to sit over here and be like within the end of the room to him. But when I walked in and found my first spot, that was Warren Buffett, and that's Greg Abel. That's Greg Abel. I can't even see from here. And Amit Jain, who runs the insurance company. No, I usually want to tell them about the NSE before we do Q&A.
Okay. So we are in discussions with Nairobi Securities Exchange, and we are looking at new security in the exchange. So as we mentioned, the idea is to get more public capital channeled towards this stage growth of companies. We started in Mauritius because Mauritius was hungry, excited, and so we're able to launch and list there. We're now talking to the NSE, and we will be talking to multiple exchanges across the continent. So the idea is that anybody, anywhere in the world, and anywhere within sub-Saharan Africa can be able to, from their own stock market, be able to invest in any of the companies within Africa Eats. So that's the idea of making it a lot easier. And so, yes, right now there are a large number of different stakeholders who are engaging on the NSE. Whether it's from the regulators, whether it's a lot of the institutional investors, whether it's the brokerage firms, the fund managers, et cetera, trustees, a large number of folks who are getting on board. And we're starting to see a similar amount of hunger here on the NSE, and investors saying, when was the last time we had an IPO or a newly listed company on the Nairobi Securities Exchange? It's been a number of years. And so this is what we
a number is like 15, just to be clear. And 15 is a number, but it's a big number when it comes to a stock market that's supposed to be listing companies.
So the long term we see is that every year we plan to take at least one company from our portfolio and outside of our portfolio to list on the exchange and create a lot more activity and attract a lot more capital to solve hunger and poverty across Africa.
Fully liquid, tradable 5 days a week online. We also built an app. Hamza's in the back here. His team in Kigali built an app so that anybody can just put it on their phone, put it on their computer, log in, trade shares. Doesn't matter if the stock market's open or not. Like, you can still go in and trade. It won't trade immediately, but you can post your order. Trying to make it easy. Easy is the key. Okay, and with that, we're going to open up the floor to any Q&A. Ask us anything you want. We are totally we're prepared for your answers. We have no idea what your questions are. Yes, sir, in the back. And tell us who you are. Oh, wait, should we do this?
I don't think we need mics.
Okay, yeah, that's fine. Okay.
Oh, actually, they may be.
We have 2 companies in West Africa. So remember, I was explaining that sometimes some companies popped up bigger than others. Yeah, so we have 2 in West Africa, both in Ghana. We had some at the very beginning that we counted as BZ in Nigeria, but we didn't actually have any investment in them. There's a long no, we have time. So investing in young companies is complicated. We had a company that came to the Fledge Accelerator in Seattle in like 2016, 2015 called Cold Hubs. They build out solar-powered cold rooms in marketplaces in Nigeria and still do. They had 1 test facility back then, and now they have 54 rolled out in traditional markets across Nigeria. We were the first investor as Fledge. Again, this is a spin-off of Fledge. I didn't name the accelerator, but that's my accelerator. We were the first investor. We put in $15,000, $17,000, something like that. We owned a little bit of the company. And then a follow-on investor showed up at the end of the program. We gave them an offer for follow-on capital. You're going to want to remember this story. We gave them an offer for follow-on capital. This other investor that was a VC fund, much bigger than us, gave him an offer that was a little bit more than us, not much more, but a little bit more. But one of the terms was they didn't want us on the cap table anymore. So we sold them our little stake. We put in, whatever, maybe it was $20,000. We sold the stake to them for like $21,000. So we at least broke even. Slight profit, but that's not a good profit for an investment fund. And so they took our position and they took their position and they owned a chunk of this company. And after about a year, the relations between them and the entrepreneur soured. I think they still own that piece. Company is way, way, way bigger now, but the investment firm never provided another dime, has never provided any value to them past the initial investment. It was not a good deal. They should have taken our money. So we counted them as Africa Eats back in 2020 because we thought, well, maybe we can buy out this investor. Maybe we'll provide new money and whatnot. And we didn't. So we eventually took them off. So we still know them. We still track them, but they're not in our portfolio. Not at BZ. And then we do have some deal flow in Nigeria on top of that. But that was our 1 Nigerian, which didn't go the way we wanted. And then again, we have 2 in Ghana, and we don't speak French. So we source a lot. It sounds a little trite, but we don't speak French. Sorry. There's a lot of people in West Africa who speak French. One of the partner programs of Fledge. So I didn't say this before. All of the entrepreneurs in all of these companies attended a Fledge program somewhere in the world between 2014 and 2020. So all of these companies were sourced through this accelerator that I built out through 2020. Some came to Seattle, everybody went to Peru, some went to Italy. Nobody here went to Barcelona, but we had a program in Barcelona. We ran a program online because of the pandemic, and I feel like I'm missing one. There's another partner program. Some of these companies attended a program that's run here on the continent called the Land Accelerator. Raise your hand if you are a Land Accelerator company. Raise your hand. Yeah, there's more than that in here. Okay, I'm only seeing 2, but I think there's like 4. We ran it in Nairobi, so I helped create that one. I ran it in Nairobi in pre-pandemic, and then it's been bouncing around the continent. Last was Accra. They've run, Sam, how many programs, including the landscape programs? 6. Okay, so they've run 6 programs in 6 years. They have hundreds of alumni. And that program purposely includes West Africa with translation, with people on staff that speak French. So about a third of the applicants are French speaking. The program is simultaneously translated into French and simultaneously translated back to English. So if I'm teaching, I know what the people are asking. And so we do have deal flow in Francophone West Africa. But at the moment, Africa Eats just doesn't have anyone on staff that speaks French to actually go do those companies and bring them in. But it's on the list. Again, our target is Sub-Saharan Africa. Anything to add? Okay. All right, next question. Yeah, all right, you pick.
Okay. You go first.
Thank you.
It's nice and loud.
Who are you and who you're with?
Yeah, so my name is Kenny Nick. I work at Back Fund. Thank you for these dispositions of funds. That's been so much learning for me. I think the part that I find most fascinating is the public market needs, and that's where my question is coming from actually. Out of curiosity, what's the trade volume like for these companies that have gone public in Mauritius? And then, follow up to that question will be, how much has been also raised through the public market so far for these sort of companies? And
Okay. I'm going to set a guideline, one question at a time, because I can't remember the second one. So I'll try and do them backwards. Total raise in so just to be clear, we never say the word IPO on purpose because technically we didn't do an IPO. An IPO is when you list shares that are sold on the first day of trading. What we did is we did a private placement followed by a listing, an introduction. So we listed every share that exists in the companies, but we raised money 2 weeks beforehand. It's one process. It looks exactly like an IPO. It's just timing wise and legalities. Total raise was $2-ish million. I don't remember exactly where it was. What I'm most proud of is that for Zoeto and Elite Meat, they each raised more money in that process than they had ever raised in the history of their companies. These are like 10-year-old companies, like 16 to 24, so 8-year-old companies. They each raised more money from the public markets than the private markets had ever provided them in their history of their companies. So that was a good success rate. Africa Eats, yeah, we raised some. And then we did a second private placement in Q1. We raised a little bit more there. So we raised about $1 million and change between those two. And the reason we did a second one, I don't think we would get that question in the room. Why did we do a second private placement like 3 months after we had just listed? Because we have needs. We have capital needs because some of the investors couldn't hit the deadline in November to invest in the previous private placement. Some people were excited to see that it's now listed. The stock price went up. I should add more money. So we got a few new investors. We got a lot of repeat old investors who liked it and just added more money in. We will continue to raise money. We're not done raising money. These IPOs are not the end of the story. They are just step one of getting money from the capital markets. So multiple times a year, Africa Eats is going to go back and raise some more money. We'll dilute people. You saw 10.8 million shares is not where we are today. We're at 11 point something now because we sold more shares. That's just how this process works for us. Right? Capital markets are a source of capital, not an exit. And then you asked about volumes. Okay. All right. So the market maker in the app is called Tuesday Markets. Sitting on the screen. Here's the logo. We named it Tuesday Markets on purpose. It has one more twist. The markets are thin. There's not a lot of trades per day. On the stock exchange in Mauritius, when you pull up the website, you'll see a lot of lines that are blank. Like the volumes are blank, the share prices are blank. It looks weird to an American eye. Those shares didn't trade that day. It's not uncommon that shares don't trade at all. And we're talking about companies that are hundreds of millions of dollars in value. They just didn't trade today. There's nobody who wanted to buy or sell. So what we said to the stock market in Mauritius is what we want to do is we want to concentrate the orders to 1 day a week. We want Tuesdays. Mondays have holidays, beginning of the week and so forth. We want to have our app collect the orders for an entire week and then have them all trade all in the same moment on Tuesday. And they said, great, we'll do that. It's called a closing auction. About half of all the shares in Euronext are traded on the closing auction. In New York, it's only about a third, but in Europe, it's really common. It didn't exist in Mauritius, so now it does. It's an option for any listed company. 3 companies chose that option. Guess which 3? And the app will collect the orders, upload them all on Tuesday between 2 p.m. and 2:30 p.m. Mauritian time. And they all trade at the same, per company, all the orders trade at one price. So if you're American, European, whatever, if you're here, you don't have to worry about, am I going to get the wrong price by a few cents per share? Everybody gets the same price on Tuesdays. Okay? So because of that, we tend to have the most volume on Tuesdays by far. And I was looking at this. So we're about 10 weeks into this year, right? 3 months in, 4 times 12 months, 12 weeks. Earlier this year, Africa Eats was at least 1 week the second most traded stock on the stock exchange of Mauritius one Tuesday. We were the 3rd most a different Tuesday. We were the 5th most another Tuesday. There's about 64 companies listed. We're about the 45th largest of that listing. So one would think that we would trade in volumes around the 30th, 40th, 50th company. But on Tuesdays, we tend to be in the top 10. And the rest of the week, we don't trade. Some days, some weeks we do, and some days we don't. But it's proof to us that if you have a market maker, it brings in volumes. It makes trades happen. And then the other 2 companies have never traded that much, but they'll still, they're near the bottom of the list of 64 companies, but there's still trades pretty much every week. So I don't think we've had a week, maybe we had 1 week where there's been nothing for those 2 companies. Okay, you have a third count? Yeah, go ahead. Last one.
Okay. You mentioned earlier that you worked with the Mauritius Stock Exchange to create a new index for the companies who took that public. How did that go? What was the process like?
Oh, okay. It was, how do we say this? We were warned ahead of time. We took some training classes from the London Stock Exchange on the process of going public. So they were nice enough. They do these online. They're free. And the gist of those trainings is it's a lot of work. We did this training twice, two subsequent years, or maybe 6 months apart. Over and over and over again, they just kept repeating that it's a lot of work. It's a lot of work. It's a lot of work. For London, it's a process that takes between 10 months and 2 years, 18 months. So we started working on this process for real in what, February, March? No, maybe it was April. It might have been April. Okay, call it April, May. This is the actual, his business made it happen. Her business also supported it. But this is our investment advisor who's makes sure we filled in all the dots and whatnot. So we started, let's say, in April. We were ready in November, but then there was an election and we had to put off the listing for a few extra weeks. So that's May, June, July, August, September, October, November, 7 months. So we did what they do in London in 10 months. We did it in 7 months. That's the good news. I'll tell you, it was a lot of work. And we did 3 of them at the same time, which to the best of our knowledge has never been done in the history of mankind. And we didn't stress that in the press or anything, but there's never been one, we'll call it IPO process, listing process, with multiple companies all in the same process, all on the same day. The only time we've ever seen in the history of mankind when multiple companies went public on the same day that knew each other was when a new stock market got launched. So the Ethiopian stock market got launched a year ago, sometime last year, and they didn't have one company on day one. They had a few, but they didn't have one investment advisor. They didn't have one roadshow. They didn't have one corporate management company. We did that. So that was kind of like 3 times what it should have been, or what it normally would be. And I would say, even with all the warnings that it would be a lot of work, even knowing that we were doing 3 times the work, it was a lot of work. But nothing that we did was hard. It was just a lot.
So before, when Looney showed that there's a cost implication for listing, I guess our goal is to slowly bring that cost implication down and to bring the process down. So even in the process that we took, I think it was a learning experience for everyone. But what we can say is, I think the biggest achievement is that we were able to get 2 of our companies listed. So we can say that it's possible for an SME to get listed on the stock exchange and to go through that process. And I guess it's best to ask them directly what they thought of that experience as well.
And Hervé signed up to do it again with his next company. All right, next question.
Yeah, thanks. I am Kyle with Kuzan Investments. And wow, amazing. I'm so inspired by what you guys have done. And question I have for you is, how does liquidity affect valuation? I think that more liquidity makes a company more valuable. Do you have a sense of, like, does it increase like 5% or 10%? Do we see all of the stocks in Africa go up in value by like 5-10% just as they get better liquidity?
We don't know. So I don't think Warren's ever said that. I'm running through like 1,000 questions I've heard Warren answer. I don't think he's ever said he doesn't know. I don't know. We don't know. No one knows because it hasn't been done. So you have an answer? Yeah, go ahead. Hand it to Shaman. Maybe he knows. Who are you? Who are you?
Mauritius. I'm sure you know where Mauritius is. It's not in the market.
Yeah. It's a dot, like right there.
The valuation of the company, we've been through that. So we've assisted these 3 companies, the holding of the 2 companies, for the valuation purposes, just to have the worth and then to have the strike price, the listing price, the initial price, for the company to be listed on the stock exchange, as on any other stock exchange. And then there are, I think Rudy pointed out to that earlier, is that there are certain methods as per the international standards of valuation that we do adhere to in order to arrive at a fair and reasonable value of the company that normally would be listed. Even if the company isn't listed, even if it's in the private space, it does reckon value. It does reckon a worth. And when a company is listed on the exchange, so the forces of demand and supply interact so as to give that sort of the price, right? It's called price discovery. But the hypothesis that we put forward in terms of whether liquidity would push the valuation further, not really. But more and more, if you have liquidity, so you have the market forces, which are demand and supply forces, they would interact in a more frequent manner, so as to produce a more reliable price, approaching to the real worth of the company. So that's a bit also that I wanted to say. So liquidity really does not have a direct impact on the valuation, because the valuation is something, let's say we see this building over there. So it's worth, let's say, $1 billion. I'm just striking it together, right? So if you have a market here, people come and then the seller wants to sell, or buyers come. So more and more buyers come and then they will discuss, etc. The price will remain the same. But more and more buyers will force the price to come to its actual value. So the more liquid the stock is, it provides more price discovery. But the valuation is something which is, of course, subjective, but normally it is within a range. It's really a discussion that we can have afterwards. But this is the sort of answer quick answer that I wanted to give to you.
And I'll supplement that to say the valuation process does not take into account at the moment. So the way we value the publicly listed companies is share price times number of shares. So if the liquidity is increasing the share price, then yes. And if it isn't, then no. And then we've only been public for 5 months, so we'll find out in the long term if the share prices of these companies continue to flow upward, or we'll see how long they drag behind their published numbers. Like that's all TBD.
Maybe one last thing I'll say is, but liquidity does reduce a distortion between the share price and the underlying value of the asset. So if the asset has a valuation, but then you're not able to buy and sell when you want to, then that does distort the price, the market price. So it does align those two together, the NAV and the share price.
Okay. There was one
question at the back, I think.
Hi, I'm Ilana from Delta 40, and thanks so much. Again, super inspiring. My questions are just if you provide any services or hands-on support, either as board members or otherwise as advisors to your companies to enable this type of growth, or if it's just kind of the capital and they've been able to drive these results.
Yeah, it's definitely not just the capital. So if it was, then all the other funds would be equaling these results. We spend almost no time providing capital. You did a study for a DFI, and what it come out to be 20% of our time at most, 15. Yeah, and I think that's overblown. I think in 2024 we only made 20-something investments, and we probably spent 60 hours on that for the year, maybe 100 for the whole year for the three of us. We spend most, and we added no new companies last year, as far as I remember. So we spent 0 time on deal flow. I did look at the pitches that came in, but not seriously. Sorry for anyone in the room who thought. I think I told everyone we weren't adding any companies last year. And so what do we don't just sit around. Again, my homage to Warren and Charlie. They do admit, like, most of their career was spent sitting in the chair reading either, for Charlie's purposes, books, and for Warren, he likes reading annual reports and quarterly reports. They also don't invest very often. The big difference between them and us is we don't spend our time reading. We spend our time checking in with our companies, finding what their challenges are and helping them solve them. And so that takes a multitude of forms. I'm going to hand it to Jumana because I spend a lot of my time raising money. That's my other pursuit.
Yeah, I think the simple way we describe it is we are far more involved than a typical board member, and we try not to be as involved as a co-founder. But because all these companies, we've known them almost from inception, it means that at any point in time, they can reach out to us and share whatever challenge they have. It could be something as simple as it's a shareholder who they would like to transition out. It could be a new hire. It could be a contract. Any opportunity they generally share with us. And so it does give us visibility. Yes, you have the contractual arrangements of how many board seats we get, but I think it's actually the openness that we have that allows us to be more involved and to receive what information that's needed. And I think that is something that's unique. The other part that's unique, which we don't often mention, is typically what you find is most funds, you raise the capital and then you look for the companies. In our case, because all these companies came through accelerators, I think probably a secret sauce is the peer learning that actually occurs between these companies. And so they reach out to one another when they have challenges. And we always try to remind them every year that there's no challenge you face that someone else in the room of the 23 companies has not faced.
Except for the biggest one.
I just had a quick follow-up question. how are you staffed to do that? I saw, your staffing bill isn't huge. Is it the two of you? Do you have like a team of analysts and associates who enable you to spend time on all of these 20 plus companies? So it's a lot of phone calls to take every week if they're reaching out.
The lovely lady behind you just handed the mic to is Lily. She's the third full-time member of staff. She's in charge of, she was an auditor before she joined us. So when we have a finance job to do internally, let's review a financial model. Let's review the historic financials for a company. Let's go teach them how to be better at finance. That's Lily. Jumani's background is, he was a banker, although he's an entrepreneur. I don't know how he survived banking. Has an MPA, not an MBA. We don't have an MBA between the three of us, actually. And then it's me. We're in 3 different cities. So we've physically been, no one asked this one. We've physically been in the room together, the 3 of us, in 5 years. I think it's like less than 20 days in 5 years, if that. I think we've eaten 1 meal together. I remember eating the meal in Dodoma. I think that's it. And I'm based in the States. So I'm States, he's Lagos at the moment. She lives in Dar es Salaam. So we're kind of a 24/7-hour business. We're always checking in with companies. In any given week, each of us will talk to a few. And so a busy week, it might be 3 each, might be 4, 3, and 3. We get to 10 companies in a week. In a slow week, it might be that we each talk to 1, right? And it's only 3. In a given month, we check in with pretty much everyone. They've told us, because we're checking in so often, again, it's not formal board meetings where we're getting updates. It's not formal board processes where we're being presented with some slides and a strategic question to answer. We're getting updates all the time. We're getting good news and bad news. We especially get bad news. And we're getting it in the form of email and WhatsApp and everything else in between. And they're almost in the form of a challenge. I got a new customer, or there's a new opportunity, let's talk it through. Or I really need this next hire, but I can't afford it right now. Or this investor is asking me for whatever due diligence it is. And so we just jump in and help them with that when they need it, as soon as they need it, as quickly as we can provide it. And since we're not distracted doing other things like deal flow, we have time to do that. So the 3 of us have no problem doing this with 23 companies. My estimate is that we can get to 30 before we get stressed. And when we get near 30, we'll just add another team member. And the next one, we've talked about this, next one's probably ops. So we have someone on staff who's an ops expert. So when we get ops questions, we can do that. And then the other answer, Jumani touched on this earlier, probably half or more of the time when we get a challenge, the answer isn't from the 3 of us. The answer is, oh, yeah, Joseph just solved that problem, or Heike is dealing with this right now, or you should go talk to, well, we got 2 Josephs. You should talk to Chris, like he'll have that answer for you. And then we literally just point you to the right BZ. And so it's not just pure learning. It's like we've seen the challenge because we're checking in. We know who solved it. We know how many years ago it was that they solved it, and then they just provide an answer. It may not be the right answer, but it's a better answer than we could provide.
Oh, by the way, if there's anybody, just to, for disclosure, if there's anybody who wouldn't want to be captured in any way for what we're capturing, then just let us know, and then we'll make sure you're not captured.
Thank you so much. I'm Adam, a research fellow at the Africa House at NYU, and I am for the Car Network Angel Syndicate. So I think Kyle mentioned, so he's sort of trekking down the same path as you guys. And I imagine that in the future, as you guys grow and become more successful, there'll be plenty of other copycats, so to speak. No offense, Kyle. So I want to know, how do you guys feel about other people sort of looking to participate in the same market? And I know you've been sort of like a steward, and you're really focused on impact, but is town big enough for the 2 of you, plus the rest that will follow, so to speak? And how do you view like those market dynamics in the long term?
Yeah, he didn't say it. The man here from Barca Fund, that's the first copycat. They're based in Abidjan. Their founder does speak French because she was born in Niger, worked for the investment houses in New York. And we helped mentor her to get her started. And then thank you, WRI, they're in the room because they helped fund it to get it off the ground. So there's multiple copycats already. We want copycats. Like, we don't want a staff of 100 trying to do this in 17 sectors. We'd much rather see 100 copycats. The more other companies that are using this model, the easier it is for us to raise capital because we don't have to teach everyone how it works. We could just point and say, hey, oh, you saw the Barca Fund. You're in the Barca Fund. Well, would you like to be in the Africa Eats investment too? And they say fund, but they'll eventually get to our model. And it got to the point, like, we published the playbook. We spent the time to write down how this works or how we think this works in a book. Next version will be a little thicker because it will cover how the public markets work, or how they did work so far. So we're really happy to see copycats. We over the years, we are Africa Eats. We have drafted up plans for Africa Power. There was a company that wanted to see if they could do this in green energy. Africa Dairy, to see if we could do this just for dairy. Africa Honey, which we'll probably do as a different version, but we had a Africa Honey pitch. Africa Tree. Oh yeah, sorry. There is a copycat in the room as well called Africa Trees. Matt here runs Realize Impact. It's an American nonprofit. They have a wholly owned subsidiary at the moment called Africa Trees. Focuses on SMEs doing land restoration and climate mitigation for profits that make money planting trees, all funded by philanthropy. So we're actually proving out through Africa Trees that this work is of interest to philanthropists at a scale where they can copy this without the for-profit piece, and then hopefully we'll add the for-profit piece soon. That's their next step. Yeah, if you or anyone else would like to make a copy of this, we're happy to spend more time on that than investing. Yeah, we think that's a good investment of our time.
Can I ask a quick follow-up, actually?
Yeah.
So you mentioned that most of your companies come through Flight Accelerator. So do you recommend that everyone has an accelerator that they source through, or like how would you recommend other people go about that so we can have the accelerator?
All right, so the normal way that investments get made, so there's like 250, 300 funds that invest in SMEs in Africa. I think that's the total list I've found. And family offices do the same thing, is they'll say, hey, we're an investor, send us a pitch. They then say no to almost every pitch, right? And the California VC numbers are, each partner at a VC firm should expect to see 1,000 to 2,000 pitches a year, and they don't always pick one per year, like not per partner. And there's usually 3-4 partners in a fund. So they'll see, 3,000, 4,000, 5,000 pitches per investment they make. So their default is no. And then once they've made the investment, they claim that they're going to do things beyond writing the check. And I'll disparage the California VCs because I was a techie. I built software companies. I took their money for years. And of the 4 I had that were backed by California VCs, 3 of them provided negative value to the company. They literally sucked our time and provided nothing back to us. And the other one was great. And I would work with them again, but they're the only ones, two guys, 2 different firms. And so what I'm seeing in the impact space, I'm not following the fintech ones, but in the impact space, there's 200, 300 funds. They promise to do more than just write checks. Maybe they do a little bit, but their job is to go find the next company. They're running a 10-year fund. They have to find all their investments in 5 years. They have to get all their capital deployed in less than 10 years because they have to exit everything in 10 years. So they're not focused on this hand-holding and support piece. And so you wind up with a relationship that's about the transaction, right? The original relationship was, I want money. Okay, I have money. You finally passed all my tests. I'll give you money. And then the investor has to go find the next one. That's what they care about. And they have to get out again. We saw this last year. We had a co-investor in Zoeto. Think that's us? Oh, okay. Hamza, can you join the Zoom call so you can let people in? All right. So we had a VC co-investor in Zoeto. They joined in 2018 or 2019. And last year, at the beginning of the year, they reached out to me and they said, well, our fund is done. We need out. I said, that's nice. Company needs money. Like they're not for sale. This is before we decided to list them. And so we had to buy out this investor. Like that's, that wasn't on our list of things to do. That was one of our largest investments last year. None of that money went to Zoeto. All that money went to this other fund that had invested in 2019 and needed out. Like that didn't fit. Okay, so your question though wasn't about that. Your question was about accelerators. So I rant about that because the alternative path is hang up a shingle and say you're an accelerator. This is what Kyle's doing with Kuzana. Everybody who applies is now looking for help as well as money. So you're self-selecting the people who are open to guidance and training and help, which is why we're able to fly everyone in here once a year and spend this year 3 days with them providing guidance and help. This is why we spend most of our time providing guidance and help, because they're open to letting us do that. And clearly from the giant graph that goes to 44 million, it works. And money alone doesn't solve the problem. Maybe if you have $1 billion fund, you can solve every problem with money. We've raised $14 million as Africa Eats, including the original $3 million of portfolio, like from the Fledge days. We've done everything on $14 million. So usually we don't have the money to solve the problem. So we have to sit down with the entrepreneur, like a good entrepreneur. We're all entrepreneurs, even Lily. Lily has a side business. We hired her because she has a side business. That was a positive to us because it makes her an entrepreneur. She understands how to build an SME in Africa because she runs an SME in Africa when she's not doing all the books for 23 companies or helping with the books. And so it's the key piece of how that relationship gets created and what it's surrounded by. And accelerator is definitely a help in that manner. So it starts with help and then it provides a little bit of money. And just be clear, my accelerators, the Fledge accelerators, always invested in the companies that got invited in. That was important too. So most accelerators on the continent of Africa just do it under grants. The Land Accelerator is a grant-funded program. And so when we're picking the companies that get into the Land Accelerator, we're picking the ones that we like, that have the most impact. Sorry, I'll just let Hamza, oh, he's the only one in here anyway. And so we don't necessarily pick the companies that are most investable or the ones that are going to grow the fastest. Whereas if you're investing in the company, then you have a different, oh, can't make it. All right, never mind. Then you're going to pick the companies that are most likely to be investable once you've helped them grow up as the accelerator. So we think the two are intermingled. And as we go forward, we're going to be sourcing companies from accelerators, from all the ones in the room that we know. And we're very likely to use an accelerator style model to pick which ones get a lot more money. So very likely we'll find these companies through accelerators. We'll give them a small check again, small now being like 50K instead of 15 or 20K. But then we'll run them through a program to make sure that they actually listen to us and then we have that relationship like we would have if they came through our accelerator. If I had more time, I would still run more accelerators. That's not the best use of my personal time. So we're not running a Fledge Africa at this point. We might do it next year though, we'll see. Yeah, we got time for a few more questions.
Hello, hi, I'm Barry from Alabama. Also work with Kyle in Kuzana as part of his accelerator. You both know what success looks like. How does a company like mine that exports avocados become like some of the success stories in the room? What does it actually take? Maybe a few points from each of you would be great.
The interesting part of sitting in this seat versus your seat is that we've seen so many companies, not just the ones that we've invested in, but the other deal flow that shows up in the hundreds of companies through the Land Accelerator and other programs. We can probably predict your next 3 big challenges before you can. And so for avocados, I'm trying to do this. We have an avocado company in Africa Trees. So there was a ban on exports temporarily in Kenya last year, right? That couldn't have been fun. They never announced to us when it ended. I'm sure you guys found out, but we never knew when it ended. You talked last night about the challenges of logistics exporting overseas, and sometimes the product shows up and it's not perfect. That will be a continuing issue going forward. And then the other one specifically to avocados is I've seen so many avocado companies come pitch that at some point it's going to saturate. At some point you're going to have too many competition and the prices are going to come down, because finally we'll get to the point where there's enough avocados in the Middle East and Europe where the exports just don't want to flow anymore. And we'll get to the point where Raj here will get all excited, because at some point there'll be a consolidation of avocado companies in Kenya. I don't think that's one of your next 3 challenges, but I have a feeling that's coming in the next 3 years, because I've seen a lot. And that's especially true in terms of just the deal flow. Like, one of the reasons why I teach at the Land Accelerator and review their applicants, and why I look at every pitch deck that comes my way, is because I get an idea of what's out there and what's happening from the pitch decks. And then I'm not sharing the businesses with the other BZ, but I'm sharing the learnings. Oh, there's suddenly a wave of companies doing black soldier flies. Well, you do this. Have you ever looked at black soldier flies? Or the opposite, which is, I've seen 100 black soldier fly pitches, and I've never seen one that had revenues above, I don't know, $300,000 a year. I've never seen $1 million black soldier fly company. That's a true story. I've never seen one. I've seen probably 100 pitches. Why is there no black soldier fly company that's hit $1 million in annual revenue? Right? There's a lot of businesses like that, especially in food and ag, that sound really easy. Black soldier flies is you take food waste, you let the flies grow on them. They're native. You don't even have to buy them. You can just leave it open. They'll show up. You grow them, and then when they're maggots, you harvest them. You kill the maggots. It's animal feed. It's a good way to do animal feed. It's cheap, but it doesn't scale for some reason. So I haven't seen enough avocado companies to know all of the issues, but those are the kind of things that we see when we're looking at companies.
Yeah, I think the simple answer I'll give is what we find is no matter how diverse the different sectors our companies are in, the challenges tend to be common across them. So I'll just encourage you to engage with some of the other folks within Africa Eats, the companies.
The scaling issues. Like, how do you get from, you were like 300,000-ish? But yeah, so just imagine all the changes that took place from when you started to now. And to get to that magical $1 million a year, you're gonna have to triple. So if you triple, you're probably gonna have 3 times the staff. All right, and if you triple in a year, this is something that happens to our companies sometimes. If you triple your size in a year, then 2/3 of your staff didn't work for your company last year. Not only do you have to hire all those people, but in terms of like building your culture and building your services, building your internal systems, like even if you double, half of your staff doesn't know what it was like when you were small. They only know what it's like now. And then when you double again from 1 million to 2, half the staff don't know what it's like to run a company under 1 million, which could be a positive, right? It doesn't mean you wind up churning as well. You find some people who just can't work at a bigger company with more processes. Okay.
Hi, my name is Gideon from Advanced Consulting. Thank you so much for the presentation, and congratulations on the public listing as well. It's great to see an investor, which doesn't happen a lot, an investor in African SMEs having this level of transparency to the public. So that's fantastic. And related to that, 2 questions. The first one being, do you have a sense of who the buyers or the people who trade the Africa Eats and the other two stocks are, apart from the ones that obviously that you sold at private placement, of course you know those, but do you have a sense of other buyers that you have no connection with, that do you have a sense of where they're coming from, how they're finding out about it?
Yeah, so talk about transparency. In Mauritius, the stock registry is public. You can, if you're a shareholder, you can request it and it will be handed to you. And I mean the whole registry, every single shareholder, their name and how many shares they own and the total number of shares. Surprised to me, I didn't know that. I didn't expect that. And so, yes, we know exactly, well, we knew on December 3rd who owned the shares because I looked at the registry then. I haven't looked at it in the last few months. It doesn't really matter at this point. We know from the roadshow in Mauritius how many institutions joined in. I think it was 5 funds. So that was a nice addition. Prior to that, we were basically invested by family offices. So the 14 million of the $14 million raise, 13 million came from family offices. And then there are trades that don't happen on Tuesdays. I will wake up and there will be an email from the broker with a trade statement. We bought or sold Tuesday, bought or sold shares of each Elite or Zoeto. So those are people who already have brokerage accounts in Mauritius. I'm assuming they're Mauritian, but I don't know. That they don't tell us. We don't have the addresses of these people. We just have names. The Mauritian names are pretty distinct. So that I can tell when it's somebody who's probably Mauritian. We haven't really we went and did this process to raise some capital, again, as a private placement from people we knew. We didn't do this to try and engage the greater public yet. We're trying to build a track record. Again, we think the capital markets will provide the majority of funding for SMEs in the next 10 years, but we need a track record to prove this out. So being public for 4 or 5 months is not a really long track record. It doesn't mean the stock price won't plummet tomorrow. The market maker is going to make sure it doesn't do that, but they don't know that. So we haven't really done a lot of advertising and whatnot to try and get the retail investors to show up. There aren't a lot of retail investors in Mauritius, and we haven't advertised the app at all. It sits in the App Store, but it's $0 spent on advertising so far. So it's people who heard about it. We were in the news. We were on TV. So some people heard and bought it. Some people also heard at the roadshow, and their institution didn't buy, but they personally bought some shares. Saw some names like that in there. And then after that, we just don't track. It doesn't matter. It's publicly available. Anything to add?
Yeah, but I will add, I think underlying your question is there's a large pot of public capital that's available. Most of it it's actually quite skewed across the entire continent. So there's a lot that's in, if I'm a pension fund, I have a lot of capital in things that are fixed deposits. So whether it's government securities, for example, or there's a limited number of public equity companies that I've invested in. And so it's actually unique to be able to say, oh, here's an equity that's listed, and here's the growth that is listed. And it's in a segment where anything is listed in that segment, I know it's going to be growing relatively fast. The reason why that's important is because most of our time actually now is going to be spent talking to those institutional investors, the pension funds, the insurance companies, and just giving them the surety and the track record for their understanding to be able to allocate that capital. So I think our anticipation is that these would be the types of investors who would continue to invest in companies.
Those are the next investors. The next big investors.
That's who we're targeting, looking at.
Okay, thanks. And my other question was around returns. So I understand that if I had invested in Africa 4 years ago, I would now have a 22.5% annualized return if I sold on the stock exchange. But that's also based on mainly unrealized returns on your portfolio, right? So have you had realized returns, cash generation from the portfolio? If not, are you planning to do so? What's the plan for sort of generating cash out of those investments?
Yeah, great. We get asked that a lot by the institutions and rarely by the families. So one of the lessons of Berkshire Hathaway is that they last paid a dividend in 1967. And when asked about it, which it was last year, asked about it in the annual shareholder meeting, Warren Buffett apologized to his shareholders for paying them a dividend. Sounds really weird. He apologized to his shareholders for authorizing a dividend in 1967 because it cost the company like $100 billion. The dividend wasn't $100 billion. The money, if they had kept it and had been reinvested at their 19.1% compounded rate, would have been worth today $100 billion or $200 billion. So it was a mistake. So the lesson we take from Berkshire Hathaway is that as long as we're compounding at 20% or better, 19% or better, best use of capital is to plow it back into the companies and keep that growth rate up. So we are promising never to pay a dividend. As long as I'm alive, as long as I'm on this board of this company, I will not authorize a dividend, right? Which for many investors, they don't want to hear that answer. That's not what they want. What I told them is you can have any return you want up to 22%. If you would like a 10% return, sell 10% of your shares. Like wait a year, sell 10% of your shares. You now have a 10% return, and you have more value in the shares, right? You can make any return you want. In terms of the capital flowing up from the BZ to Africa Eats, right now the best use of all of their profits is to plow it back into the growth because on average they're growing at 55%. So any dividend that they paid to us would be a bad economic choice. At some point, they will slow down. It is not possible to continue to grow at 50% indefinitely. At some point, you become a company doing 20, 30, 40, $50 million in revenue, and growing 50% is adding 25 million in revenue at a $50 million company. That's next to impossible, right? It is possible, but it's next to impossible. And so at that point, they should start paying dividends. At that point, if they're listed in our path here, then they've sold a quarter or a third of the company out to the public. And if you pay a dividend to the public, then you'll get more investors. That's a common thing for post-exponential growth companies, like when they're topping off, to start paying dividends to attract more investors. And when they do that, Africa Eats will still own our shares because we never intend to sell any shares of any of these companies. So we will then get part of that dividend, whatever piece of the company we own as well. So in the long term, we expect to have a very large amount of cash flow from 100 companies where 50 of them are paying dividends. That's a long time in the future. At the moment, we're just spending money raised from investors to make this bigger. And so we had one of our investors question us on why was your expense ratio so high? Because if you look at us as a fund, we spent like 10% of our total ever income of capital, not our net worth, but our $14 million. We spent like 10% last year on expenses. And so as a fund, that's outrageous. Like you should fire your fund manager for doing that. But we're not a fund. Like we spent that money investing it in the public markets to open that path up for more capital for our BZ so that we don't have to go raise all that money ourselves. That's an investment. It was a good use of capital. You just can't look at us like a fund. Like we're kind of apples and pears in that method. So if you look back in the historic pieces, well, where did the money come from to run the company for the other 3.5 years? Yeah, it came from raising money from investors, and in spending the money on the team here and this event and like events like it, we've grown the value of the company from 3 million to 27 million. So all of that was, I would say, really well spent. That created the 22.5% compounded growth. It created the 2.5x growth in less than 5 years, spending some of the money on, water and pencils. Make sense? I know it's very, very different than, Berkshire, again, go back to Berkshire. Berkshire has a big established companies that are all paying dividends almost all paying up dividends to the parent company or the main piece, which is how they got $300 billion. Like they just have cash that's flowing in. We'll get there someday. We're just not there yet, and not trying to get there. Not trying to get there soon.
If your focus is investing in fast-growing SMEs, and you're saying at some point they will level off, would it make sense to get some cash out of that by selling those stakes and investing it back in younger, faster growing?
Oh, I love that question. We asked to show, so stand up if you're a BZ. Stand up if you're a BZ or just an entrepreneur, Africa Trees, Africa Eats, Kuzana, it doesn't matter. Stand up, stand up. Okay, so we got some entrepreneurs in the room here. Okay, raise your hand if your goal is to sell your company in the next 10 years. Okay, raise it, or all the way up, raise it. Okay, two hands go up. If you want to sell your company in the next 10 years, like your goal, you're building your company to sell it in the next 10 years. Yeah.
Hands up, anybody?
Hands up. So we got, that's fine.
Sell
To
it,
sell,
yeah,
to
your
sell.
company.
Oh, your hand went back down.
So, no hands.
Not listed to the public, sell it. Like you no longer own the company, you have to go do something else. How many hands go up for that? Like, yeah, okay, you can sit down. Thank you for that. Yeah, we did this question to the room a few years ago as well. We got a slightly different result. We got one hand up last time. These entrepreneurs are not interested in that VC model of, I want to grow a company, fatten it, sell it off to somebody else, go do something else. That's not what they're building. They're building the next big brands of Africa.
But your stake is different than them selling the whole company.
We're with them. We're not their co-founders, but we are closer than board members. We're with them as long as they want to stay. And so if they don't want to sell their company in the next 10 years, we're not going to sell our stake either. If somebody comes along and says, if Tyson Foods of America comes to Africa and says, I need chickens, I got to start up the chicken business in Africa, they're going to knock on Hervé's door. And if they write him a big enough check and he says, I want to sell the company, then we'll say, great, congratulations, and we'll take their money. But we're not going to go, if he tells us, go find us a Tyson chicken to buy my company, we'll tell him, go hire somebody else. We don't do that.
But think about it this way too. So we're a public company, and most of the public capital that's available are pension funds, insurance. Yeah. Think about like their cash cycle. So they have a large pot of wealth, and then they pay a little bit out for, health reasons, etc. So this fits perfectly well with that model. There's not a need to cash out, so to speak. What they want is they want an asset that's perpetually growing. So this is why this is aligned to getting those types of investors on board. So that way, yes, we're liquid because we're a market maker. So when there's a need to have a small amount of liquidity that's taken out, that's available at any time. So we actually believe that if we want to grow the majority of SMEs in Africa, you need, put it this way, if you took 100x the number of private equity firms and venture capital firms in this continent, it will not solve getting access to SMEs in Africa. You need to have a vehicle that's created that matches the capital that comes in, matches the companies that we just said, that these people none of these entrepreneurs plan on selling. And so that's the entire cycle that we're trying to build, away from the investor, the entrepreneurs. Same thing, if you talk to the farmers, they'll say the same thing. Their goal is not to sell their farm and go somewhere else. So the entire financial ecosystem we have in Africa, if it doesn't align from the beginning to end, it's never going to grow at scale to be able to have the impact we want to have. So that's what we're looking at.
Okay, we have time for one last question. Okay.
Question for Jumani. Jumani, I think you.
Who are you?
Oh, sorry. I'm Matt Eldridge with Realize Impact. Jumani, I think you sort of touched on this earlier, but I'm curious to know a little bit more about how do shared services work with Africa Eats? How do you support your BZ with shared services?
Yeah. So I would say in the same way that we just had the entrepreneurs stand up, if we were to ask all the different entities or organizations in the room who support us in various capacities stand up, there'll be quite a number of them. So, and the question was alluded to before, how is it possible that Looney, Lily, myself were able to work with so many companies? It's because of the number of folks who actually believe in the model and who are supporting it in different capacities. And so I would say that's a core part of our shared services. So for example, whether it's Kyle Hare, who has helped a number of our entrepreneurs getting additional capital, whether it's through grants. He's helped us with a number of companies too, in terms of putting in place their environmental and social management systems. That's been tremendous. One of the big steps that it took for listing some of our companies, so Elite here or Zoeto, a big part of the shared services that came out of that was actually us partnering with our investment bank, with Rogers Capital, our management company, and helping to put in place the capacity they need to be able to list. So whether it's formalizing their board processes, whether it's ensuring that they have all the different legal documents in place, et cetera, in preparation for listing. So that's a tremendous amount of shared services that Africa has partnered with that is available to our various companies.
Bookkeepers and accountants.
Yes, lots of bookkeepers, lots of accountants.
Explain that.
And actually, because of that, we've now created, it's almost like a roadmap, if you will, that says, if I'm a company that's earning tens of thousands of dollars, then what are the main services I need? So we've identified within finance, within governance, within HR, what exactly do you need to be able to achieve that? And then we internally can allocate our time to be able to advise on that, but then we work with various partners to do that. And then what we add on top, though, is when we identify that there's a common challenge that our companies tend to face, then we would then spend the resources to build out that capacity. So we found that finance, for example, is an area that we support a lot of our entrepreneurs. We've tried different things, like, for example, getting accounting systems on board, but we found that probably what's more effective is being able to identify and have accountants who are on the ground or auditors who are on the ground. And so what we tell our companies is, as you grow, we then require we require you to improve your level of finance or your level of or the quality of your finance. So what does that mean? When a company hits $1 million in revenue, then we would pay, for example, you going to a tier 2 auditor, so a globally recognized tier 2 auditor, and we would pay for that initial audit to be done, and then thereafter you can then pay for that audit to be done. When you hit $1 million in revenue, we normally then look at the quality of your finance staff, and then we would say, okay, you have an accountant, you have a CFO. We think you actually need to build it out more, and so we'll then be involved in the recruiting process, and then we'll pay for maybe the first 3 months of hiring that person for you to see the value, and then be able to say, okay, I'm willing to then do that on board. Same thing we do when a company lists. This is why I mentioned the Perigm and Rogers Capital. We would pay for the first year for you to list. That's a shared service that we provide. But then thereafter, you're then responsible for paying for the costs involved in being a public listed company. And so for us, it's really just being a catalyst to identify what the challenges the companies face. And then we would create this, or we'll pay for that service, so we'll provide that service. And then thereafter, you'll then continue to provide that.
Real quick.
I have one question.
Okay, last question.
Yeah, last question. So how long does it take to list one company or one bunch of business to another? How long does it take?
Well, we're trying to get it shorter, but it took us 7 months from the time we said go and started our weekly meetings to the listing day was 7 months, which is really fast. And it was busy every week for the whole 7 months. There wasn't any lull in there. There were no holidays off.
Just to add on that a bit.
Yeah.
The 7 months, right, relatively quite fast, short, but if a company is well structured, like you said, with all the processes set up, we could do that within maybe 4 months.
So our goal going forward in this process, like, again, I keep saying we're opening up the capital markets. We're doing this as a shared service. Our goal is that by the time we're in 2026 doing this for the 5th company, or 2027 hopefully by the 5th company, we've already gotten them in shape before we even start. Like, we know what the process is now. And so we know we're not quite there with truck, but then one after truck, like, we will have all the processes in place before we even introduce them to Perigm. And then we'll just say, okay, this company needs a parent company in Mauritius, because we always do that as part of the process. Rogers knows how to do that a lot now. We've done like 5. And here's the checklist of everything you're going to have to provide to Perigm. So when you have that ready, we'll introduce you to Perigm. And then everything will be there already. We can probably get the process down to just a handful of months. And the long part is we'll have to go and talk to investors, because every time you do this, you need investors to write checks. Like, we don't do this just to list. We do this as a fundraising exercise. And so the part that's out of our control is which investors are going to invest in this company this time. And markets go up and down, and the global economy goes up and down, and other things get in the way. And as Jumane said about an hour ago, we're not just doing this in Mauritius. Our goal is to do this with every single stock market in sub-Saharan Africa. That'll take us a decade as well. But our goal is that no matter which country you're in, no matter what your local stock market is in, you will be a publicly listed company in Mauritius and your local market, if not all of them. Right? Our goal and our dream is all of them. That's another big audacious goal. All right.
My name is Nadine from IFAT. I'm looking at the investment side. The question is, do you have the impact report where we can see the number of small farmers that are linked to the companies, each company for the program?
Yeah, we mentioned this in the, we've been publishing at least 4 reports now for a few years. Like regulatory wise, we're required now to publish 4 reports per year. The annual report from last year, for the 2023 annual report, has a section on measuring impact. And the unfortunate piece is that we can't track the number anymore. So what we did for the first 3 years was count how many smallholder farmers' lives got touched by the BZ. And then we had a couple 60 decibel reports that other investors paid for, showing that on average the incomes were doubled. So we had anecdotal evidence that the incomes had been doubled. So from that we could estimate the reach that we have, and we lost count. And the reason we lost count is the companies got so big that they couldn't have direct relationships with every farmer anymore. They had to go and source from aggregators, and now we're one level away, and we don't know how many farmers are in each aggregator. We don't know what the incomes of the farmers are on the other side of the aggregators. And so I've reached out to groups like GIZ and and USAID back when it existed, asking for a grant to go do that work so we can measure it again. But at the moment, we just don't have the number. All we have is our revenue number. We know approximately what percentage of that revenue goes to the hands of the farmers. So we can make an estimate for how many farmers that is. But we can definitely say how much money went in the hands of the farmers. And we've never really reported how much tonnage of food we've moved around. But we do know the post-harvest losses in our companies are small single digits. So we know we make a huge impact on that end, but we never published a report showing how many tons of food that is. So we would love to do that. We would love to actually measure the improved lives of every single farmer whose lives we touch, but that's something we can't afford to do as a for-profit. That's not a use of our income statement that we can justify to our for-profit investors. But we would love a grant to go do that, and we've been asking, but we haven't found one yet. Okay, so with that, thank you for all the good questions. That was fun on our end. Hope it was fun on your end. So looking at the agenda, we're going to break out into networking at this point. So your task, if you are not a BZ, your task as a guest is to find 3 BZ in the room. The breakout is around the corner over here. And then we start back here at 11:45 to do some topics. You guys are going to, so if you don't have a topic in mind as a guest, think about that for the next 45 minutes, because the topics that we'll discuss when we're back are going to be topics that you suggest. We're not bringing the topics, you're bringing the topics. No, anything you want to bring. We're going to have you suggest, and then we'll have the BZ vote. We did this last year. It worked really easily. So we'll see you in 45 minutes or 40 minutes.
40 minutes.
40 minutes.
You have a picture of the...
Oh, look at that. It's 2 of us. Bye, YouTube. We'll post slides later.